Just 4 weeks ago, this value investing model portfolio was overperforming the general stock market by 11%. And at the peak, this portfolio achieved a return of about 15% in less than 3 months' time. Yeah boy, Stijn over here was chuffed to bits. He was already doing the quick compounded interest math over at investor.golf to see when he could retire. Because honestly, that pace of returns was insane. Like my girl Nelly Furtado has once said, all good things come to an end. And thus, my streak of serious overperformance on the stock market has also come to an end. Fast forward a couple of bank failures, shout out to Credit Suisse in particular, you guys are absolute mad lads. Minus 95% in 5 years time, thanks to being involved in literally every single banking scandal of the past 2 decades. That shit is impressive. Anyways, fast forward a couple of bank failures and yeah boy over here is all of a sudden underperforming cash. By the way, those are just some fancy words for saying this portfolio is officially in the red. Now, of course, I have a plan to change that. I am confident that this strategy will allow me to significantly overperform again in the future. And in this video, I am going to explain to you what steps I'm going to take in the next couple of weeks, months and years to achieve just that. But before that, first, my transactions explained. Okay, so between the last update and this video, yeah boy over here made 2 different stock transactions. Number 1, Stijn sold the remainder of his Tesla shares, 5 pieces in total, for a price of $180 per share. So the Tesla saga has officially ended for this portfolio. And that means that over a total holding period of less than 2 months, we made a 644 euros profit on Tesla, which comes down to a 56% return compared to my average buy-in. Not bad for just 2 months of investing work. And I am really happy with how this Tesla investment has played out. With hindsight, I do not believe I would have done anything differently. In 2023, I believe $200 to $250 per share for Tesla is its intrinsic value. And therefore, since I'm a value investor looking for freaking bargains, between $125 and $100 per share seems to be a good buying price for Tesla. So with Tesla now the price tag of $190 per share and therefore a P ratio of 50, well, for now, I am forced to sit on the sidelines, sadly. But yeah boy certainly ain't being forced to sit on the sidelines for this stock. Clearfield, of which we purchased another 25 shares for an average price around the $47 mark. You see, Clearfield has been absolutely slaughtered on the stock market during the last couple of months. In fact, it's down about 66% compared to its most recent high. And well, Mr. Bargain Hunter over here actually puts an intrinsic value for Clearfield at around the $100 mark. Meaning, I believe anyone purchasing Clearfield today for around $45 per share is getting a phenomenal deal. Clearfield right now is one of those buy one, get one for free kind of package deals. And thanks to that insane value proposition, Clearfield has ballooned to a 75% share position, which equates to about 22% of the portfolio. If you want a more in-depth overview of Clearfield, I would highly recommend checking out this video where I go in-depth into why I believe this company to be so amazing. And those were 2 transactions of this period. By the way, this is how the portfolio currently looks. Base Resources and Clearfield by far make up the large position in this portfolio. And I expect you will continue to see these 2 companies, Base A and Clearfield, UWMC, Google, as well as Porsche over the next couple of updates. ASTS might be heated out of this portfolio reasonably soon, but I am still awaiting a significant catalyst to occur before that. Now let's talk about which steps I am taking to return to significant overperformance. So here is my plan. And my strategy is really simple. Step 1, buy stuff when it's cheap. Step 2, hold that stuff until it becomes uncheap. And step 3, sell when uncheap. It literally is that simple. That, in essence, is how I'm going to run this portfolio for the next couple of weeks, months, and even years. You see, of the stocks in my portfolio, some are a little closer to intrinsic value. For example, UWMC, while other stocks might be in the mega cheap category, like Clearfield. I believe this stock to be heavily undervalued. And because I hold different stocks in this portfolio, each with different distances to intrinsic value, some cheaper, some more expensive, well, that gives me options. Options to sell the more expensive stocks like UWMC, to buy the more cheaper stocks like Clearfield. So what I'm trying to say is, even though we do not currently hold cash in the position, in fact we actually have a tiny marginal position of 422 euros. Well, even though we do not really hold cash, we still do have the option to buy the dip when some stocks become especially cheap. Moreover, this is a portfolio with monthly deposits. So in a couple of days time, more money will be added to this portfolio, which will allow me to continue buying the dip on some of these stocks. Now, I should emphasize that my plan only involves a bottom-up research approach. I only look at individual companies, and when they're cheap, I buy them. I do not look at macroeconomic events or data to determine how I should run my portfolio. Don't get me wrong, having a good macroeconomic view can help running your portfolio, but determining whether you should invest or not should always, in my opinion, be based on the true intrinsic value of a company. So in essence, this portfolio is being run and will continue to be run with a value investing mindset. Hopefully that is clear. Now we should compare to the S&P 500. So at this moment in time, the portfolio is down 1% compared to holding cash. But since a dollar cost average into the S&P 500 would have resulted in a loss of about 3%, we are actually still overperforming the market with more than 2%. Not really the way I want to overperform the stock market, but overperformance is overperformance. Like I've said in almost all of my previous videos, value investing will most likely result in very volatile returns. So this underperformance figure should change significantly going forward. And that is fine, as long as in a couple of years time we will have achieved a significant overperformance figure right here. After all, that is the goal of value investing, long-term returns. Now, that was all I have to add regarding this portfolio today. Hopefully I will see you all again in 2 weeks time for the next portfolio update. But before that, time for a classic YouTuber disclaimer. While I am a registered financial advisor in the Netherlands, I do not have the legal capacity yet to give anyone investment advice. Therefore, this video and any other video on this YouTube channel can never be taken as financial advice. I cannot be held liable for the losses you make while trading according to my opinions. Please do your own due diligence. And with that said, thank you so much for watching. I love you all. Peace.